Hello again and welcome to Simplexity Blog. This is an overview today of managed futures and portfolio diversification opportunities. This is a brochure that is presented by CME Group, and if we take a look in the back, CME Group, you can get the information from the CME Group. You can go directly to their website and download this piece, or of course there are brochures that can be sent out to you, but just wanted to touch on the highlights. This is only going to go into the highlights of managed futures and this brochure. Starting, what are managed futures? The term managed futures describes an industry comprised of professional money managers known as commodity trading advisors, or CTAs. These trading advisors manage clients' assets on a discretionary basis using global futures markets as an investment medium. Now, trading advisors take positions based on expected profit or profit potential, as it says here. That is to say, they are similar to a mutual fund manager, except for the mutual fund manager is looking for profit potential in the underlying stock or company and its change in price and value. CTAs are doing the same thing within the commodities and futures space. Okay, you can also see here that in the investment universe, managed futures, well, the traditional asset classes would be cash, bonds, equities, and real estate. Alternative asset classes include managed futures. Managed futures are not hedge funds, okay? There are some distinct differences, including, and one of the key factors is that they are completely open, transparent. You can always see what's going on inside your managed futures account or with your managed futures CTA. There's no secrets. You know what positions are on, how they're doing, and that sort of thing. Skipping down here, managed futures have been used successfully by investment managers or management professionals for more than 30 years. These are not brand new instruments by any means. With the ability to go both long and short, managed futures are highly flexible financial instruments with the potential to profit from rising and falling markets. Moreover, managed futures funds have virtually no correlation to traditional asset classes, enabling them to enhance returns as well as lower overall volatility. And really, as a background, or with my background in financial management as an advisor, that's key. I'm looking not just to find something that has a potential high return, but also has this gigantic risk. I want to see a portfolio, an overall portfolio, where potentially you can get lower risk and higher returns. That's what I think are some of the beautiful things to potentially adding managed futures. Now, managed futures are not right for everybody, and anybody that says they are, well, they're probably trying to sell you something. Benefits of managed futures. Trading advisors can participate in more than 150 markets, from grains to gold and currencies and stock indices. In this example below, the overall risk is reduced by almost 82%, from 41% down to 7.5. That's a negative 41 down to a negative 7.5. And the return also increases almost 20%. From 7.4% return to almost 8.9% return. Now you can go through and take a look at this if you get a brochure. I'm not going to go into everything here, but just hit the highlights. I do highly recommend, though, getting a brochure or going and downloading it online. It's a great PDF to have and take a look at. Opportunity to enhance overall portfolio returns. This is showing you the optimum portfolio mix between the dates of January 1987 through February 2008. So what you see here is this is a risk, 6% up to 12%. So lowest risk is over on the left. returns are running up this way. Lowest returns 7% up to 12% returns up here, okay? Now, what you really want is where this little orange dot is, right? You know, less risk, highest returns. That's what we're all looking for. What this is showing you is, and I colored that dot in as well for illustration purposes, what we're looking at here is a portfolio of 50% stocks, 50% bonds, had roughly, over 8% risk and over 7% return. And then as you add non-correlated assets, in this case, this box right here, or this circle right here, has 40% bonds, 40% stocks, 20% managed futures, and it reduced your risk considerably and increased your returns. So that's a great thing. If you just wanted to add, and it doesn't display what the mix would be exactly, but if you wanted to keep your risk, okay, at the same thing that you feel comfortable with as far as your portfolio right now, then you theoretically could add managed futures and get a higher return. So you would have the same risk, but potentially 2% higher return by finding the right mix of managed futures, okay? This has been, all right, so all this information I'm telling you has been substantiated by an extensive bank of academic research, beginning with a landmark study by Dr. John Lintner of Harvard University, in which he wrote, the combined portfolio of stocks or bonds and stocks, vice versa there, after including judicious investments in leveraged managed futures accounts, show substantially less risk at every possible level of expected return than a portfolio of stocks or stocks and bonds alone. So landmark study there by Dr. Lintner. This is also referred to as the efficient frontier, and was part of Dr. Markowitz's, Professor Markowitz's studies. If you turn the page, this next page is just the diversification opportunities, the different investment vehicles that CTAs can invest in. Not going to go into that too much. Here we have opportunity to profit in a variety of economic environments. Managed futures trading advisors can generate profit in both increasing or decreasing markets due to their ability to go long, buy futures positions in anticipation of a rising market, or go short, sell futures position in anticipation of a falling market. Moreover, trading advisors are able to go long or short with equal ease. This ability, coupled with their virtual non-correlation with most traditional asset classes, have resulted in managed futures funds performing well relative to traditional asset classes during adverse conditions for stocks and bonds. Lastly, as far as points, the ability to recover quickly. Taking a look at this. Additional managed futures. Actually, let me jump back over here because this, you can't see it real well, but the green are just from 1987 till September 2001, the times that the stock market has retrenched or had a drawdown. And in each of those times, the blue are what managed futures, how they performed. So in only one case did managed futures actually go down same time that the stock market went down, and in every other case they went up, which is displaying the non-correlation aspect and just how that can, a visual picture of maybe how your portfolio can benefit. Additionally, managed futures generally have shorter recovery times from drawdown periods, is what this box is showing here, and I'm not going to go into that very much. So then the brochure talks a little bit more. Those are the highlights that I wanted to point out. I do recommend that everybody go to the CME group, download this, or somehow get a hold of the Managed Futures Portfolio Diversification Opportunities brochure. Every Managed Futures CTA is not created equal, just like every mutual fund manager or investment advisor is not created equal, and you need to do due diligence to find one that is going to fit you and has the track record and the ability to create the returns that you are looking for or the portfolio that you are looking for. Have a great day.